Good evening, everyone. Welcome again to our Outlook seminar, and again, Kong Hei Fat Choi to everyone. As April managed to be able to point out, we do still remain bullish in the market, and I know some of you have probably questioned this in the last couple of weeks, maybe months, because you have noticed some degree of declines. But the reason we're bullish is because we've seen declines like this before, and we just come out of a bear market, and you don't go back into a bear market that quickly. But anyway, we'll be looking at what prospects markets will have on the technical angle, and of course supporting by much of the facts that we're going to be looking at today. So we did entitle our report Still Bullish Despite Some Challenges, and perhaps as the year of the rabbit will show you, it clearly will be a very bouncy year, and so we're going to expect a bit more of it. All right, so let's start with an overview, and I'd just like to be able to point out that markets have continued to be able to show uneven paths. In fact, it was the title of our report in the last engagement we've had with you in the latter half of 2010. And markets continue to be able to direct themselves in that particular condition. Particularly hard hit were, of course, countries in Southeast Asia. And I'll try to explain to you a little bit why that also happened in a little while so you can see and try to be able to get some bearing of that. Now, some headwinds continue to be able to reason out rotational movements in markets, and this is why some markets are experiencing wider corrections as compared to other types of markets. And these corrections, which I believe to be Elliott's wave number 2 system, of which I'll discuss that also later, will eventually bring out the next higher level into markets that will condition, of course, the next buying wave for everyone. All right. Now, looking at this particular graph, I'd just like to be able to show you the performance in the last 1 year of the Philippine Stock Exchange Index. This is that green line you see up here, and that's compared to the movement of emerging markets in general, and the bottom one, which is the S&P 500. And if you look at it very, very clearly, you'd notice that the performance of the Philippine Index not so long ago was tremendously much more in terms of its advance compared to some of its peers. And this is the reason why, of course, itself, along with some other countries, and if you would see here on the right side, included in the top 4 markets during that period were Thailand, Philippines, India, and China. If you were just to be able to look at it, these are the countries right now that are reading in, because I feel that markets went a bit too wayward upwards, and they were quite overbought. And these are the kind of markets that are trying to be able to pull away into corrections today. So these are necessary movements. And in order for prices to be able to rectify these things and allow people to take some profits and new investors to get back inside and create a new base, these corrections were bound to happen. And they were quite lacking in the last 2 years. Now, I wanted to be able to show a slide I showed you last time I spoke with you, and this was in the latter half of 2010. And during that time, if you would notice, this is the graph of the S&P 500, and you could see that the S&P 500 was going through a major corrective wave. In fact, it was quite a scary feat. Everybody was quite worried about it. And if you notice on the opposite side, on the right side, this is the graph of the Philippine Index. If you were to look at the two, and you try to recall in what's happening today, you have completely the opposite situation happening. And that simply means that this is the kind of rotational action that markets sometimes will have to engage in. And every time markets come towards a period of an overbought condition, and you would see cascading declines come off that, well, we had our share of that towards the latter portion of 2010, and this is the reason why we're trying to be able to pay for that today. Now, I will show you now the updated charts of both of them so you can see the performance, and you can see that it's just completely the opposite of one another now. Now we have the S&P 500 going back into a new high quite steadily, and now you have the Philippine Index coming back down to be able to play out a corrective move. Now, there's really nothing quite unusual about this other than the fact that, of course, there is mobility of funds from one investment to another. And sometimes when something moves a bit too much overpriced, fund managers have a tendency of taking profit in one and moving to something that is a bit more attractive. But to be able to understand that the whole holistic view over here is still quite intact, and there's really been no fundamental change to be able to assert that. But as you can clearly see, the trend structures are very much still intact for both of them, except that we're probably going to have to be able to test some of our supports perhaps in the short term. Now, these things, so these corrections that are taking place and these rotational aspects have actually been orchestrated by, of course, funds. And perhaps let's try to better understand why they're doing it in a much more clear prospect. Now, what you're seeing in front of you is a graph depicting the general gains of hedge funds, these ones on top, as compared to the gains of the S&P 500, these blue lines you see in the bottom. If you see green lines coming on top, that means hedge funds outperformed the S&P 500 in that particular year and quarter. If you notice that it's the blue bar that they're showing you, that means the S&P 500 outperformed the hedge fund managers. And if you'd notice and look at short-term history, you would see that the S&P 500 has actually managed to outperform fund managers for several quarters right now. And that's put a lot of pressure into the hedge fund manager, and this forced them now to be able to recalibrate their ways to be able to engage in investments. The reason is quite simple. As markets were turning around, a lot of people did not believe that markets were turning around in the first place. One of the bearish folk were still hedge fund managers. I still know a lot of them who are extremely bearish. And these are the reasons why some of them have not really been able to cope with the rising tides. And these kinds of conditions now, this has put a lot of pressure on them, because what they're going to have to do is they have to be able to prove themselves a bit better by performing better. And if they don't want to be left behind, what a lot of these hedge fund managers do is they copy one another. And it's not that I'm just coming up to be able to disclose that fact. In fact, that's actually happening for real. In fact, if you were to look at this statistic shows you the correlation between movements between hedge fund managers. And what this reading over here is telling us, that there is a 70% chance correlation that when one fund manager loses, the rest lose. And when somebody makes money, they all make money. And when you have a correlation as high as that, that means either they're probably looking at each other and looking at their books to be able to try to see what is done. So what's happening right now is we're going through what we call a pack mentality syndrome, where fund managers are looking at each other, seeing what their latest stories are, and they're pounding on it at the same time. And it's because of that we're getting some exaggeration in some of the advances and some exaggeration in some of the declines. Now, perhaps that could have cast, maybe the Philippines should not have gone down that much, but because of the liquidation going on and the movement of money elsewhere, I will show you where the drift of money is going in a little while. But this is clearly enhanced by, of course, this particular type of phenomenon. Now, another thing, since, of course, they're moving in this particular types of packs, they don't do it untowardly. They are looking for, of course, quite quality grade investments when they're doing that. Now, because they're doing this and they're trying to increase gains, they're just doing things much quicker. Instead of looking at things as very much long-term, they're switching in a very medium-term aspect. And this is why, of course, certain degrees of volatility have been playing out in different markets also. So that particular syndrome is that you can't beat them, then follow them strategy is what they're doing right now. And we have to be able to understand that, because some markets will move a little higher, faster, and perhaps with more fury. And the same conditions will happen also on the way down when they start to be able to rotate the funds aspect. Now let's try to be able to look at where funds flows have been going and try to understand why some markets have been going up and some markets have been going down. Let's look first at the positive end. The markets that you see in front of you, this is Taiwan, United States, Korea, and Germany. There are a few names, there are other names in there, I didn't include them anymore, but in general, these markets are actually flourishing because they're receiving quite a bit of funds flows from these fund managers. And some of them have also maintained a relatively good currency valuation, so if they can keep them at a good currency and keep them invested in quality equities that are also rising, then of course they're experiencing double the gains in these particular types of markets. And you can clearly see that in all of the four, we do have uptrending tides in each one of them, and they look very different than the kind of market we're going through right now. Right? So at least you can see that there is funds flow coming and being invested into equities. It's just which one is better at this point in time, and then eventually when these guys be a little bit more expensive, the money will rotate out of them and will come back to those that have managed to make corrections. Keep that in mind, because that's what brings about the next opportunity for all of us. Now, these are the markets that have been getting hit in the short term, and if you could look at them, China, Indonesia, India, and Thailand. If you notice, much of the names, these three names were included in the first slide I showed you, which showed that these particular markets have gone up tremendously, and were probably the winners, or one of the few winners that you saw back in 2010. So what they're doing right now is they're going through a profit-taking phase, but it doesn't mean that they've changed their long-term trend. And you can clearly see the corrections. We have got trend lines breaking, and we're currently still in that corrective wave. We haven't broken above that yet. But prices have come down quite tremendously, especially for countries like India, Thailand, Indonesia, China. I didn't include our market there. I'm sure you probably dream about that every night. So I think you know where we are enough to be able to understand where that facet is. All right, and looking now into a little bit more on the currency side, because the play right now for fund managers is not just looking at equities, but how to be able to take advantage of placing into countries whose currencies are also doing well. And so for those particular countries whose currencies are also getting hit like this, for example, we got the Philippine peso, the Indonesian rupiah, the Indian rupee, and of course the Thai baht. All of them managed to be able to devalue a little bit in the last few months. Now, of course, this clearly expresses there is some funds flow moving out and moving obviously to other markets. If I were to show you the respective currencies of the other slides I gave you, you'd probably see currencies of the other ones or the stronger markets are still holding relatively stable as compared to what we've had. All right? The other, of course, concern that some of these countries have is since our countries were growing relatively rapidly, and as was earlier stated by April, it is really the threat of inflation. And thus, inflation, if it climbs up too much, can drown away some of the earnings that you would make on the investment such as this. So you can clearly see that the investors or fund managers are playing a very defensive game in their strategy, and they're doing things much more sharply and quickly as compared to the way they used to before. Now, let's talk also about the euro, and let's talk about the US dollar. If you can look at these two particular graphs, you can clearly see they look completely opposite than the other. And this particular type of movement still tells you that, of course, the euro right now is still trying to be able to make a rebound. Although I think it was just around the corner, and I'm sure many of you, as well as we, were also concerned that, of course, there was a big problem in Europe, and they say there still is. But you can clearly see that some calming effect has already moved back with the appreciation back of that euro. And we'll look a little bit about how that thing can be a bit explained to you and see more evidence of that into particular European markets in a little while. The dollar, again, continues to be able to be pressed down, and I don't see any change in trend. So the dollar's conditions are still very much lower as compared to what you're seeing on the above chart. So much of the movement into the euro was really clear-cut by some of the improvements. Of course, the European Central Bank said at all costs we're going to try to help, of course, our member countries to try to be able to figure a way out of this particular crisis. And, of course, two of those particular countries, which is Spain and Portugal, recently generated a very successful bond offering, which raised, again, expectations that people who were fearful of any liquidity problems in these countries had nothing to worry about in actuality. Of course, the dollar index, of course, is still pushing down, and in most likelihood, it will probably come back down to that previous low. It might even break it, and I really don't see any impact change onto that immediately because trends are really quite forceful. We've seen lower highs, has clearly been shown there. We've also had lower lows, and we will now examine to see whether we can see any inherent change in that perhaps in the next 3 to 4 months.